Well, hello. How's it going? This is Rob Reinhold, and we're going to be talking about market crashes and economic cycles. This is one of my absolute favorite topics, and let me give you a little background why. I started trading in late 1997, and I traded during the dot-com boom of 98 and 99, and in 1999 I became absolutely convinced that the market was going to crash. And I did very well in 2000. The market crashed in 2000 and crashed in 2001. And those were my two biggest trading years up to that date. And I fell in love with trading during market crashes. And I actually only wanted to trade in market crashes for the rest of my life. I wanted the market to just crash all the time. Now, of course, we know that that's not reasonable, but I really loved the kind of price action and the direction that the markets took. And again, things happened quickly, they happened fast, and you could really build your portfolio value quickly. So I fell in love with being short and being bearish in market crashes. The problem is that really kind of hurt me because all I wanted to do is be short the market. And I turned into what I call a perma-bear. And a perma-bear is someone who thinks that the sky is always falling, and that was me. That was me from about 2002 to 2004. The sky was always falling, and I actually underperformed those 2 years. I should have done much better, but I was locked into one side of the market. I wanted the market to crash, and I traded that way like the market was going to continue to crash. So I've absolutely fallen in love with shorting, fallen in love with the bearish side of the market, but I learned that you really need to be unbiased as a trader. And so the thing that I also learned was that even though things were terrible and markets were crashing, you know what? It didn't last forever. And people got back to work, people started spending money again, and it was simply economic cycles. And that's the one thing you really need to understand when you look at things like market crashes and the history of market crashes, is that these are natural and normal. They're going to happen. And I don't want to get too far off into Fed conspiracy theory talk because that is a rabbit hole that I think a lot of us could go down and talk all day about, or all night. But basically, the Fed and central banks were created in order to reduce these market cycles. Hey, let's start the Fed off so we don't have such big depressions anymore. And let's start the Fed off so we don't have these massive asset bubbles that create these real problems. Well, ever since the Fed and other central banks have been introduced into the market, guess what has still happened? Economic cycles, rises and crashes. And so in the end, that is just natural. There's nothing that's going to change that. This is just human nature. And so during your trading career, you're going to see up cycles, you're going to see down cycles, you're going to see crashes, you're going to see flat periods, you're going to see all of that. Now, according to the NBER, the average length of an economic expansion is just under 5 years. And then the average contraction lasts 11 months. So that's basically a 6-year cycle, where 5 years in, on average, we then get about a 11 or 12-month recession. Now, of course, that's never going to be an exact science. Sometimes there's 2 to 3 years between market cycles in history. Sometimes there's 9 to 15 years between market cycles. But just, we want to get into the averages so when we start to look at current market conditions, we know where we are. And that's really what this is all about. As a trader, we trade price action. If things are going up, we go long, period. Whether things are overvalued, undervalued, whatever it is, if the price is going up, we want to be on the bullish side. And if the prices are going down, we want to be on the bearish side. However, as a trader, you have to be conscious and looking for potential changes. And these big market tops and bottoms that happen to these big cycles, there's a lot of money to be made around those periods of time. And so the one thing I want you to understand is that, look, it's natural, it's normal, it's going to happen. As a career trader who's going to trade for 10, 20, 30, 40, 50 years, you're going to see these all. You're going to see runs, you're going to see bubbles, you're going to see crashes, you're going to see recessions. We just need to know how to identify them and how to trade in them. That's really what this is all about. And so in the end, look, we're traders. We trade off of price action. This is more general economics. And so please don't take anything in this session to where you're going to do something tomorrow, because I'm going to tell you a sad little story at the end of this session about what I did in 1999. And in 1999, I was convinced the market was going to crash. So what did I do? I shorted, and I shorted with pretty much everything I had. I was right, but I was way too early. Way too early. So I'll tell you a sad story to make it to where you don't want to repeat what I did. But we need to start at least thinking about where we are in the economic cycle, because if we can get a little bit of an idea on that, it can really help our trading when we go to look at supply and demand. Alright, so what I'm going to go over here is straight out of this book called Manias, Panics, and Crashes. And I read this book back in the late 90s. I read this book again in 2001. And I pulled it out again in 2008 when we were in the depths of the panic from the banking industry. I pulled it out again, and it actually really helped me understand, oh, okay, this is what's happening, this is what's going to happen, and at some point there's going to be a bottom, and this is what you want to do. And so I highly recommend this book. Now look, if you're just new to trading, you really should be focusing on charting techniques, trading, position management, position sizing books, stuff like that. Once you're an experienced trader and you've got that down, this is just a fantastic book to read through and really get a more of an idea on the economic cycles of the past. And it's interesting because you'll see that they've all repeated each other. And as we know, history often repeats itself. Alright, so let's talk about some of the economic crashes we've seen in history. And I want to start with the very first economic crash that is in recorded history. Of course, I'm sure economies have crashed all throughout history, but we didn't start writing things down and keeping records until about 400 or 500 years ago. So the Dutch Tulip Bubble, we're going to talk about 5 of these. The Dutch Tulip Bubble is one of my favorite bubbles of all time because it wasn't even about financial products. It's just so interesting. It wasn't about real estate or stocks or bonds. It was about tulips. Now, the tulip craze hit the Netherlands in the 1630s, and they had just become introduced into the Netherlands from Turkey, I believe. And they were a very colorful flower, and one of the most colorful flowers that you could grow in the Netherlands. And what happened was it became a sign of wealth and a status symbol based on the tulips you had in your yard. And certain colors let people know how wealthy you were. If you had, a pink and orange one, that meant you were very wealthy and you could afford these bulbs because these bulbs were very expensive. So, like anything, people react to supply and demand. And the demand for tulips became amazing, just amazing demand. And a couple things happened. Number one, there were exchanges that became set up. So local exchanges opened up in towns where people would go to the tulip market, the tulip bulb market, and they would sit there and they'd buy tulips and then they'd sell tulips that same day. Some tulip bulbs change hands more than 10 times a day from people flipping tulips, if you can believe that. The other thing that happened is it really created the first futures market because people wanted tulip bulbs. So they would go to farmers and say, look, I'll pay you today for next year's crops. And so farmers started selling futures contracts on their tulip bulbs. And so what we have this huge demand that's chasing this limited supply, and people are selling futures on supply that's not even there. Well, what happened was, of course, at some point the asset became way too expensive. And at the very top, some tulip bulbs sold for more than 10 times the annual income of a skilled craftsman. Just one bulb was worth more than that. It was crazy. Well, the price came apart supply came on the market, demand waned, and prices crashed by over 99%. And it actually created an economic recession in the Netherlands. So businesses went down, people stopped spending money because people lost a lot of their life savings in that. The next market crash I want to cover is the Great Depression. Alright, the Great Depression, we all know it started off with the big market crash of 1929, and the stock market lost close to 90% of its value over the next 8 years. Corporate profits tumbled, unemployment skyrocketed to 25%, GDP fell 46%, and the Federal Reserve, they actually made some mistakes that made this even a little bit better, or sorry, a little bit worse. You know, as you go back in history, the Federal Reserve, they cut the money supply. They made less money available to the public, and the president at the time, Hoover, he entered a lot of protectionist tactics where he limited trade, he cut immigration, he had labor and wage and price controls, basically determining what companies could pay for or could sell their products for. All of that really made the Great Depression worse than it would have been. So we got this huge loss. Again, unemployment skyrockets, the Fed makes a couple mistakes, but really what led to it was the Roaring Twenties. And hopefully you've heard of this term, the Roaring Twenties. It's called the Roaring Twenties because there was a huge boom, and there was a recession in 1921, and the Federal Reserve, who was new at the game, they came in and kept their interest rates very low. They slashed interest rates, and they kept interest rates low at 3%. Well, anytime there's new technology, there's usually a frenzy. We had auto, radio, movies, aviation, biotech, all these new technologies hit. So the market attracted the public, and the public kept buying. And we saw huge surges in the Dow Jones, 500%, insurance policies surged 114%, real estate surged, and we saw high levels of margin and borrowing for the public. That's what led to the Great Depression, was that the people basically went crazy. They created a bubble going into that. Alright, let's jump forward to the 1980s. Because you think, okay, we figured things out, right? We know what to do and what not to do. Yes, we made some mistakes back in the 18th and 19th century. We're not that dumb. Well, in 1986, Japan had a recession. So, what does the Bank of Japan do? They slash interest rates and print more money. They go into quantitative easing. Well, that created a nice little boom, and what happened is real estate went up. But in 1989, the real estate market crashed. The Nikkei went from 40,000 yen to 7,000. That's an 82.5% decline. They call it the lost decade because the index really went from 7,000 to 15,000 for 20 years. The Nikkei is currently at 19,000. Again, this is May of 2017. We're still down 50% from where we were over close to 30 years ago. Now, why did this happen? Well, as I said, there was a recession in 86. The Bank of Japan cut rates, enacted monetary policy, and then they made rules like, okay, we're going to force the banks to make loans. So every bank had to make a certain number of loans, regardless if the credit quality was there or the borrower or not. They had to make loans. So this caused the banks to make a lot of loans to people. And since the banks were giving out loans, people took the money and they bought real estate. And the Japanese land values tripled in the matter of 4 years. And at one point, Japan's imperial palace was worth more than all the real estate in California. We saw a huge jump and spike in stocks as well. All of this happened leading up to their crash. And again, that crash was really horrible. To me, this is the worst one because even the depression, it came back. This one didn't come back. The Japanese are still feeling this almost 30 years later. And it was all because of a price bubble, an asset bubble. Here we have the dot-coms. This happened in 1999. Again, we're not that dumb, right? We're learning how to handle the market. The Federal Reserve is very sophisticated and knows exactly what they're doing. Well, some of us, I know we all lived through the bubble. Some of us were very young and didn't even know that there was a bubble forming. But this was my first experience. The NASDAQ lost 78%. That just blows me away. When I hear that number, 80% of value, and I'm thinking, no, this is the United States. We don't have crazy market swings like this. We're a stable, advanced economy. Nope, we still get these kind of swings. The S&P 500 lost 50% of its business. We saw lots of companies go out of business, and we saw lots of losses. The FOMC, what do after a market crash? They cut interest rates. Well, let's see what led up to this. In 1998, something very important happened. There was a recession in Asia, and that recession in Asia caused the Russian ruble and some other currencies in that area to plummet. And there was a fund, a big hedge fund called Long-Term Capital Management. They were worth billions and billions of dollars. They were over-levered, 30 to 1, debt to equity, and it caused a massive collapse in the stock market and in currencies. And in response, the Fed, they cut rates. Now, they cut rates even though the U.S. economy was very strong. Remember, we were right in the middle of the dot-com craze. We're at the very start. Business was doing very well. Things were really good, but the Fed cut rates because they were scared. After that, the NASDAQ went up 273% because, again, the Fed printed money, the Fed cut interest rates, they attracted new investors to the market. That's why we got that last surge in 1998-99, was because of the cut in interest rates. And then let's take a look at the last one, and then we'll move on, because this is a great history. As I said, read that book. There's so much more. But the point of this session is to really talk about cycles, how to see them coming, how to identify them, and how to profit from them. So the Great Recession, we had a biggest fall in real estate we've ever seen in the U.S., 30%. The S&P 500 lost 57%. Unemployment went over 10%. So what does the Fed do? Well, they slash interest rates. Slash interest rates to zero and introduce quantitative easing. Now let's see what led up to the Great Recession, or what caused it. Well, we can start to look at the Fed again. After the market crashed in 2000-2001, what did the Fed do? The Fed cut interest rates. They slashed interest rates all the way down to 2%. And they said, we're going to move very slowly because we just went through this big recession and we don't want there to be another bubble again. So we're going to keep interest rates slow. So what happens? Interest rates are low. There's lots of money in the money supply. People are going to use that money to buy things, and that's what happened. Housing prices surged 64% in 4 years. That's enormous. That's so far above the average. Oil surged up to 150. We got mortgage-backed securities that were the real problem. There was a huge demand because big investors like institutions, pensions, insurance companies, they can only invest in fixed income. That's stuff like government bonds. However, government bonds were only paying 2%. They need to make a higher rate of return than that. The other thing they're allowed to invest in was mortgage-backed securities that were rated AAA by rating companies. So they wanted to buy those. However, there was only a limited supply of mortgage-backed securities, so the way capitalism works, if there's a supply and demand imbalance, supply will meet demand. If there's too much demand, supply will meet it. And so they started making more loans. More loans. The insurance companies were buying them, and the credit rating agencies were rating them AAA. Anyway, it created this big bubble. And created this big bubble that really led to the recession. So hopefully, as all these stories go, we talked about the crashes, but to me, The interesting thing was that all of these crashes share the same thing. Leading up to the crash, there was an asset bubble. And that's what really leads to market crashes. And what we really want to talk about is that in economic cycles, we are always going to have corrections or pullbacks. A pullback is when the market goes down a couple of percent. That happens all the time. And then we get corrections sometimes in the market. Now a correction, the technical definition of a correction, is greater than 10% but less than 20%. So anytime the equity markets go down between 10 and 20% but recover, that's called a correction. We get pullbacks and recessions all the time. Bear markets are pretty substantial. In bear markets, the average bear market loses 34% of value, and that's what we're really talking about, is how do we see when these bear markets are coming. And we just went through 5 of the most recent bear markets, and I think you can see that the thing they all have in common were the behaviors and actions leading up to the decline, called a bubble. So the characteristics of a bubble, we've got 3 of them here. Disbelief amongst the public that there is a bubble. If you remember the dot-com craze, dot-coms are going crazy, and everyone's like, oh, they've already gone up too much, they've gone up too much. Even Alan Greenspan, in 1995, he came out and said the market is irrationally exuberant. Basically meaning people are going crazy. That was in 1995. People got a whole lot crazier than that. At some point, it's like, we need to get in. We have to get in this. In 2005, real estate prices were going up. But in 2006 and 7, every single seminar across the country and world selling real estate was packed. Everyone was getting in. We got to flip these houses. My neighbor just bought a house for $200,000 and sold it for $250,000. We've got to get on this action. 2, asset prices are substantially higher than intrinsic value. We're going to discuss this here. We're going to discuss what intrinsic value is. We're going to take a look at multiple asset classes on this. And number 3, the velocity of money increases substantially. For those of you who are in our currency program, we talk about the quantitative theory of money. This is what the Fed uses. The quantitative theory of money is basically the money supply on one side and prices on the other side, and real value and perceived value. And one of the components of that quantitative theory of money is velocity. Velocity is how many times does a dollar change hands in a given period of time. Let's just take that if on January 1st we put a tracking device on a dollar bill and we went and spent it. That dollar bill would be given as change to someone else. It would be spent again, and then it might be saved for a couple weeks and then spent again. If we could count how many times that dollar bill changed hands over the year, that is the velocity of money. And during asset bubbles, the velocity of money is very, very fast. Go back to the Dutch Tulip craze. We talked about those tulip bulbs change hands sometimes 10 to 20 times a day. Think about all the money being exchanged during that period of time. There's a lot of velocity of money going. And so that's what we want to look for when we ask the question, are we in a bubble? Now, of course, anytime you ask this question, it's going to be a different time of the market economic cycle. Sometimes you might be close to a bubble, sometimes you might be far away. But these are some of the things you want to look for and ask yourself, okay, are you in a bubble right now, or in a year from now, or 5 years from now, or 10 years from now? These are the things that all of the bubbles have in common. We talked about the fear of missing out. The public is the greatest tell as far as are we in a bubble. When you start getting stock trading advice from the person bagging your groceries, and from the cab driver, and from your brother or your uncle or your brother-in-law that has always been terrible at making investments, when you start getting advice from them, that's when you know it's a problem. One of my favorite stories is one of our instructors, Corey. He has a brother-in-law that was always that guy, always making the wrong investments at the wrong time. And in 2009, oil crashed and tumbled from 150, and it was down to about $90. Sorry, this is 2011. So oil had come down all the way to $90 from 150. And he asked Corey, who'd been a trader for years, "Hey, Corey, I really want to buy some oil futures. How do you do that? How do you buy oil futures?" He didn't know how to buy oil futures, but he knew Corey did, and that was like a sure thing. He's like, "'Cause it's going to go right back up to over $100. And Corey said that that day he went and took a short in oil because he knew that that was likely not the top, but the market was going down. And sure enough, it did. It continued to go all the way down into the 50s from that point. So when you get the public to where they are in a frenzy, and again, go back to the dot-coms. People had to get into dot-coms, get into the real estate bubble in 2006. People had to start flipping properties. Everyone was talking about real estate. All of a sudden, that's when it's time to get at least a little bit wary. Now, that being said, that doesn't mean it's going to crash today. Doesn't mean it's going to crash in 6 months. It doesn't have to do anything. But these are signs. So some of the hard numbers that we can look at are things like investor sentiment numbers. There are surveys that go out and ask investors, are you bullish, bearish, or neutral? Now, obviously, the more bullish people are, the more likely you are to be near a market top. You also can take a look at odd lot sales. Odd lot sales are any trade that is less than 100 share increments. So if you do a trade, or if a trade goes through of 72 shares, that's not a big institution stepping in and buying it. That's not a big trader. They trade in lots. That's mom and pop. So the higher amount of odd lot sales there are, you know that mom and pop are in there aggressively taking positions, and that's usually a sign that we're near the top. And then number 3, margin and debt levels. Margin and debt levels. People tend to borrow a lot of money at bubbles because it's a sure thing and they have to get in. So let's just take a look at some of these things. Here's a chart of investor sentiment, and it's a chart going all the way back to 1990. And you can see that the points of time where the market really got high really correspond nicely with market tops. As you can see here, we have little pullbacks or recessions during all these times. When sentiment was very high, we definitely see pullbacks. Again, this is something that there's no quantifiable, hey, that's the exact number. But when investor sentiment is very high, it's telling you, okay, people are very bullish, people are overly bullish. Now again, remember, we're traders. We don't go short based on our feelings. We only go short when the price action tells us to go short. Some of the greatest gains you're ever going to get are in the last stages of a bubble, being on the long side. It's amazing. It's absolutely amazing how much money you can make during the bubble. It's fantastic. We just want to be smart as traders. When it all flips around, we'll go short and we'll make a ton of money in the crash. Unlike people that just bought in 2000 and then held on and then never cashed in their profits and sat through all the pain. We're traders. We don't do that. We don't do that. We're not investors. Contrarian indicators, we talked about odd lot sales. When odd lot sales are high, it's a sign that, okay, there's lots of people in the market. When short interest is high, it also tells you people are betting against this market. If people are betting against it, people don't believe it's real, which means it's probably not the top. When people start saying this is going to go on forever and this is a no-brainer, that's when you start to see some contrarian indicators. Odd lot sales. I got to tell a quick funny story about odd lot sales. The worst odd lot sale I've ever seen happened to me personally. It was in my first couple years of trading, and I put out a limit order to buy 1,000 shares. So a limit order is I will only buy shares at a certain price. So I wanted the stock to come down a little bit, hit my limit price, so I can get filled for 1,000 shares. Well, the stock came down and barely touched that limit price, and I got filled for 4 shares. 4 shares. And then the stock turned around and went back up, and I never got filled for the rest. 4 shares. When I got that fill, I was like, who in the hell is trading 4 shares? Like, talk about an odd lot sale. And I was like, back then, commissions were like $25. Someone stuck me with 4 shares. And I had to pay $25, and then guess what? I had to turn around and sell those 4 shares for another $25. It cost me $50 in commissions, and I remember thinking, who in the hell is out there selling 4 shares? But I remember thinking when I hit the sell button that I dumped my 4 shares on someone else, and I'm sure they were thinking, who in the hell just dumped 4 shares on me? So I think those 4 shares have just been circling around the market endlessly, because one person wanted to start with a joke of 4 shares. But that is, I mean, talk about an odd lot sale. That's just a silly story. All right, investor sentiment. Again, I'm not going to get into these because, depending on when you're watching this, the numbers are going to be totally different. But I'm showing you, you want to go out and look at these numbers. This is margin debt. It's very easy to go out online and just say, what is the margin debt? And you can get charts, and you can get graphs. And you can see during this period of time, we are at a high level of margin debt. We're at a high level of margin debt up here. We're at a high level of margin debt compared to the growth of the S&P 500. You can see whenever it gets stretched away from that, we tend to have market crashes. Now again, it can last for a long time, but it's showing us there are some signs of the market being stretched. The next thing, again, the first one we're going to take a look at is what are the public doing? Are the public acting like weirdos and crazy? And you can look at all those indicators and make a determination. Yes, the public is acting like it's in a bubble. Second is intrinsic value. So intrinsic value and market value are different. Now, market value is what the asset is trading for right now. Intrinsic value is what's it really worth. Now, this is where it's a little bit difficult, and this is where fundamental analysis fails all the time, is that market value can be wildly different than intrinsic value and stay that way for a long time. There's a famous saying in the market that the market can stay irrational a lot longer than you can stay solvent, and that's true. But when you take a look at the current value versus intrinsic value, it's another sign our asset value is stretched. So intrinsic value is what it's worth, market value is what the market currently is trading for. So the easiest thing to take a look at is things like PE ratios. So if we take a look at stocks, everyone looks at PE ratios, is basically how much are you paying for a dollar of earnings. In the end, stocks trade off of their earnings power. So PE ratio is a great way to take a look if things are currently overvalued or undervalued. Second, we're going to take a look at real estate. How do you see if real estate is overvalued? We're going to talk about that. And then number 3, we're going to take a look at book value and cost approach. All right, so we need to know what the average is. The average PE ratio for the S&P 500 historically is 15.6. Now, this is what's called trailing earnings, or TTM, trailing 12 months. It means this is what the company has actually earned. Now, Wall Street likes to play with these PE ratios all the time, and they talk about current PE. Current PE is based on the estimates of the company this quarter. Forward PE is what it's going to make. I love when they come on the TV and say, well, this stock looks cheap based on 2022 earnings. Wait a second. It looks cheap today based on what it's going to earn in 2022? That's your justification for value? So we want to take a look at trailing 12 months, 15.6 or 16, I like to round it up. So the historical average is around 16. The highest it's been is 123, the lowest it's been is 2. But you can see during the 2000 market top, we were trading up around 40, 43. We can see that during market crashes, again, 1920, 1929 and 1930, we got peaks as well. You can see that these peaks typically led to market declines. At any time, it's very easy to go see what the current PE ratio is on the S&P 500. In this situation, it's 25. That is historically high. Now again, this doesn't mean the market's going to crash tomorrow. I'm going to tell you a story that should really help you never make the same mistake I did. This is just a little red light saying, hey, just be cautious. Look, still be long the market. If the market's going up, we want to be long. Just be aware that there might be some trouble. When you take a look at intrinsic value of real estate, when we take a look at stocks, stocks are worth how much the company makes. I remember having a debate with my sister-in-law, who was a real estate agent at the time back in 2006 and 2007. And I made the argument that real estate was overvalued and it was ridiculously overvalued and going to crash. And she said, well, that's not true. Like, we bought our house for appraised value. It's not overvalued. We bought it for what it's worth. And I said, well, wait a second. Appraised value is only using other houses that sold in your neighborhood. If those 3 houses were overvalued, your house is overvalued. And I explained to her that it's relative valuation. You can't value your property based on other overvalued properties. It doesn't make it fairly valued. It still is overvalued. And she said, well, then how can you value real estate? And I said, the income approach. And this is what they do with corporate properties. They take a look at how much income the property can generate, and they put a cap rate on it, 7%, and that gives the true intrinsic value of the property. So you can find these. These are easy to find. You take a look at, price to people's income. What's the average house to price to income? You can see in bubbles, this gets very extended. And in regular times, it gets very cheap. You can see where we are right now. We're basically at 100, which is average on this reading. When we take a look at price to rent, if you were to rent that property out, how much money would it generate? You could see that in these 2 real estate examples, real estate is not overvalued. It's actually pretty close to fairly valued. Price to rent is a little bit below the average of 100. Price to income is a little bit above. Now, when you see these numbers start to creep up, you start to say, oh, there is a possibility that there is a real estate bubble forming. But again, it doesn't tell you anything more than that. It does not tell you there's a top, because you could have easily called a top back in 2002 at 120 and at 125 and at 128. Yes, at some point it'll top out, but you can't make a decision until it actually changes. And then the last one, I don't want to spend a lot of time on this metric, but this is book value. Book value of a stock is basically if they took all the stuff that the company owns and sell it off for parts, this is what it's worth. Book value is a pretty draconian way to look at this, but it is showing you what is the true value. And in real estate, you can do the same thing. How much would it cost me to build this same property? If I could build the same property for $300,000 and it's trading right now for $500,000, that's a little bit overvalued. So these are some of the metrics that you can use, as I said, based on when you're taking a look at this video, and not just now, but 2 years from now, 3 years from now, 5 years from now. All these numbers are going to be different based on where you are in the economic cycle. I just want you to be aware that there are things that you can look at that will show you where we are in the economic cycle. Are we close to bubble territory? Are we so cheap that it's time to buy? Is it time to run out and buy real estate hand over fist because it's so cheap? Or is it too expensive? So you can use this to really help out. And there's one indicator that I really like. Now, before I get into this indicator, let me preface this by saying I'm not a big fan of indicators. When you get into any of the courses that I teach on charting, you will see that I'm very clear on that. I'm not a big fan of indicators. I think they give lots of false signals, and I think people ignore the price action because an indicator is flashing this or that. Price action volume and trend are by far so much more important than indicators. But there are some indicators that are very, very helpful at times, and for me, the ADX is one of my favorites. And again, I rarely pull out the ADX. I only pull it out when I think there's a market top or a major market bottom in store lately or in the near future. Now, the ADX is the average directional index. The great thing is it's a trend indicator, but it really takes into account how big the candles are. So when you're looking at a candle chart, if there's a lot of expanded range candles, that means candles that open up at the low and then close up at the high. So that means that, a big candle would be a stock that opened up at 30 and closed at 32. In comparison to a stock that opened up at 30 and closed at $30.20. The larger the expansion, the stronger the reading on the ADX line will be. And so you really get these great readings at tops and bottoms, because at tops and bottoms, this is when the most extreme activity is in play. And you get the largest candles. And so if you line up these buys and sells, it's really amazing. Anytime this ADX got over 40, it was a really good time to sell. And anytime it got down below about 12, it was a pretty good time to buy. So again, play with the ADX. There's lots of things out there on the ADX online. As I said, these indicators are really there just to be used sparingly. Price action is going to tell you everything. If we take a look at right now where the ADX is, right here, right now, it's at 18. Now look, the market has had a substantial run. A lot of people are thinking right now we're in a bubble. The ADX is not even close to telling you we're in a bubble. So again, the market is going higher, the trend's going higher, the ADX isn't even close to bubble territory. It's probably time just to stay long until the price action breaks. Alright, now again, I wanted to go over all these things just to talk about market cycles. And the biggest reason for this session is really to talk about bubbles. Bubbles are the cause of the big financial collapses. And seeing when we're in a bubble, seeing when we're approaching the top of a bubble, it gives you as a trader a real heads up. Now again, it doesn't matter. We aren't going to use this to call the tops and bottoms. We're going to use charting, we're going to use trends, we're going to use all the things that we're going to learn and then go through to really call tops and bottoms. But it is extremely dangerous to try to call them. Let me wrap this up with my second biggest loss of all time. It was my biggest loss when it happened. In the fall of 1999, I was absolutely convinced that the dot-com stocks were in a bubble and the market was going to crash. I was convinced. I knew it was going to happen. I knew it. Everything was overvalued. People were acting crazy. Everything was bonkers. I knew the dot-com bubble was going to burst. And I came across a stock in the fall of 1999 called Phone.com. Now, Phone.com had never, ever sold anything at all. They had never recorded $1 of revenue. They had never even recorded $1 of profit, because they can't, because they had never even sold anything. Now, this company also didn't have a product even to sell. They were thinking about making a product that had something to do with a phone or a computer or some combination of the two. They weren't sure what it was going to be, but they were going to make a product to sell to people. They came public. Never, not a dollar in revenue, not a dollar in earnings, not a product to sell, not even a good idea of what they were going to sell. But they came public. And the fact that it was called Phone.com, people bought the stock. The stock came public at 20, went up to 40, went up to 60, went up to 80, and when it was at $100 a share, I thought to myself, oh my gosh, this is it. I know we're in a dot-com bubble. And look at this stock. This stock is the biggest piece of garbage I've ever seen. There's no way this doesn't crash. There's no way. And it's at 100. I know a lot of times when stocks reach round numbers, they fall. I thought, you know what, let me short 1,000 shares here at $98.50 or 98.5 at the time, still in fractions. And this thing's going to pull back to at least 80. I mean, it's going to go to 0, but I'll at least get 20 points on this if I'm just patient on it. So I shorted 1,000 shares at 98.5, and I put in my stop at 99 7/8. I was just trading stock at the time. So I've got about $1,500 of risk on the line. You know what? This dumb stock didn't want to go down. It went up, and it got up to my stop, and I said, I don't want to lose $1,500. This is phone.com. This is the biggest piece of garbage. I know there's a .com bubble. I know it's going to crash, and this stock is worth 0. I know it. So what did I do? I canceled my stop order. Well, things started to get pretty uncomfortable around $125 a share. So I'm like, this is hurting, but I better take some shares off. So I took some of my short off, and I thought when it starts going back down, I'll add them back on. But I got to lighten up a little bit. Well, somewhere around 170, I had to lighten up again. Thought, this is so brutal. I've got to lighten back up. I got to take some more shares off the table, but as soon as it starts to crash, I'm going to put them back on. But I didn't want to get out of the position because I knew I was right. I was absolutely convinced. Well, at $215.05, I still remember that price, I was forced out of the position by a margin call because I didn't have any money left to hold the position. I had some money left, but it wasn't enough to hold the position. And so they closed my position out. I had lost about 75-80% of my trading account. I was devastated. I tell people this job has brought me to tears before, and that was the time. I remember driving home in my car from the Maverick office in tears. And it's ironic because that was the lowest point in my trading career, but it was also the turning point. It was the turning point that made me realize that I don't know what's going to happen. And it also was a turning point where I promised myself I will never let one trade take all my money. If I'm going to lose my money, it's going to be over 100 really crappy trades. But I will never put myself in a situation. I took about a month off of trading. I borrowed some money from my dad. I got back in, paid my dad back within 2 months, and I had a fantastic 2000 and 2001. Made it all back and more. I tell you that story to tell you that you cannot call tops and bottoms. If you do, you just got lucky. Don't try to call tops and bottoms. Remember, we are traders, we are fast. We're traders, we're fast. If it's going up, we want to be buyers. Once it goes down, we want to be sellers, and we'll hold on to it, and then when it changes, we'll go back to being on the long side. We don't have to be like I was in 1999, making these grand bets that we're going to make fortunes. Trading is all about consistency, money management, and being on the right side of trades. So again, market crashes. This was really about market bubbles. Bubbles are the things to watch out for. I've given you a couple of tools to look over it. Again, we're going to talk about how to trade in bear markets, how to make the most amount of money in bear markets. We're going to cover all that in all the option sessions, but we just wanted to make sure you understood market crashes. All right, thanks for joining me, everyone. Take care.